In this recording, I'd like to follow up from another recording that I did on the topic of enterprise valuation. In that particular recording, that you should definitely listen prior to listening to this one, because in this recording, my assumption is that students have listened to the other recording and understand one of the methodologies that are related to valuation. So they are both connected. What I like to do, instead of using a PowerPoint, this time around I am going to use a Word document. This way, by design, I am making it a little bit wordy, and the benefit there is that I will provide this document so you have it and you can make notes as you are listening to it. So the goal here is to talk about enterprise valuation, pricing the value of a firm. These conversation tie to what you should have read by now. I know you have, many of you, hopefully all of you, from Demystify Business Valuation, specifically in chapter 5, 6, and 7. So in the separate recording, I spend more time on talking about how to use the discounted cash flow method. So here I was just going to provide a summary so you have it all in one place also. So to calculate the discounted cash flow method, we're using the DCF, or also called the net present value. As I mentioned before, and as you probably know, the net present value basically means the same thing as discounting cash flow, because the present value is you discounting the future cash flow to the present value. And in order to do that, you have to discount it, which means you are dividing it by 1 plus the discount rate. So again, this is all in reference to chapter 5, business valuation, and also the recording that I have done before. Now, first I want to do is to, again, as a summary, talk about two methods, two in the sense that what if there are two types of businesses. One would be like the Max Inc., which has a high growth rate because it is starting out, and it will grow for 5, 6, 7, 8, in our example, 10 years. And after that, it will then slow down. All businesses do not grow at a very, very high pace. Even companies like Intel and Cisco and even Apple and Google, they grew at a pretty fast rate in the first 10, 15 years, but then eventually, obviously, they get big enough and then the growth rate slows down. So first I want to talk about is how would we use the discounted cash flow if we had to use it for a company that is in a growth rate or a startup company like Max Inc. So the step one for any calculation for using discounted cash flow is to calculate the discount rate R by calculating first the WACC, or the weighted average cost of capital. And again, there is a separate recording on that topic, as you know, that talks about how do you calculate the weighted average cost of capital, and also then layering some risk elements to get from WACC to the discount rate R. And again, this is also in the chapter 7 of the book, but more important, my recording provides some steps and some more detail above and beyond what you're going to find in chapter 7. Once we have the R done, obviously, the next we do is to calculate the value of the company using the cash flow. So we have obviously cash flow for Max Inc., as we know. And there are two pieces for the valuation. The first piece is what I'll call part A. That is based on the specific cash flow that we have forecasted. And by that I mean, in our case, we have forecasted for 10 years of cash flow. So there is a discounted cash flow value of those 10 years, or net present value, which is one and the same thing as DCF. So when we calculated it, again, in this example, what I did for the recording that I'm referring to is the one for how do you do the discounted cash flow or the net present value for valuation. There I use 15% for discount rate. And again, my focus for that recording was not the discount rate, which I covered in a separate lecture. Here was more the methodology of how do we figure out the valuation. So again, I'm using 15%. You would use whatever you come up for your R. And that was the net present value for the business for the 10 year. Now, if the business is going to continue beyond the 10 years, then obviously this is where the terminal value conversation comes in. And here I'm going to call that the part B of the valuation. and we're going to calculate the terminal value of the cash flow that will occur beyond the last year. In the case of MaxInc, it is beyond the 10th year. So for part B, first you have to do is to estimate a growth rate. What is going to happen beyond the 10 year? You can use some research site like IBIS that has industry data and can come up with what the growth rate could be for this industry. Or if you cannot, in most cases you will, a plausible baseline assumption for a growth rate for a mature company would be typically about 3% in the United States, because our economic growth rate is about 3% on average. Some years would be less, some years is more, but typically if you look at a long term, it grows at about 3% a year. So 3% growth rate will be plausible. And that is what the formula calls out as G, the growth rate. So now that we have the R, which is the discount rate, now we have the G, which is the growth rate. Next we're gonna do is to calculate the terminal value, again using the last year's cash flow, and again, more detail in the other recording. So this is a part B valuation of the company. So this is the chart that I'm showing on the bottom, is one of the charts in the prior recording. And there, what I have talked about is that we will have part A, which is the net present value of the cash flow from year 0 to year 10. And the part B will be the growth value of the cash flow value from year 10 beyond, and that's the part B, which is where you calculate the terminal value. And then because we are calculating the terminal value of the cash flow from that point on, because it is in the 10th year, because we're using the 10th year cash flow as a basis to figure out the future, we would have to discount it till today. So we'll take the terminal value and we will discount it to today, and then we add them up. So again, this may be hard to read on this chart. Maybe I'll try to see if I can make it a little bit bigger. Here we go. So you can see there are two pieces there. One here, which is the 1799, which would be the net present value of the cash flow from year 0 to year 10. Again, using 15% discount rate. If you use a different number, obviously you'll get a different number. If you had a discount rate was different than 15. And the one below that, 1.488 million, is the discounted cash flow for the terminal value. The terminal value using 697, which is the last year cash flow for this business that we have calculated, we're using this to forecast the future. The terminal value, using the formula for terminal value, which is a cash flow for that year, times 1 plus G divided by R minus G, we'll get a terminal value of 5.98 million. But that is in year 10. We discounted it by dividing it by 1 plus R, which is for 15%, raised to 10, which is the 10th year, and we will get a 1.48 million. So the enterprise value using the discounted cash flow, or NPV, where R in my case is 15% and G I use is 3%, I would get that number. And again, your formula will be the same. Your R and G may be different, so your numbers may be different. Now, what if a business was already in a mature stage? Obviously MaxInc is starting out, so it's growing pretty fast and it slows down. But what if it was not like MaxInc, or what if it was something that is already kind of growth? How do we use DCF or discounted cash flow to do that? In that case, the formula will still be the same for terminal value, but where we would do it is to use the current cash flow. For example, let's say company ABC has a cash flow in 2012 of 1,000 and 2000 and this should be 2013. Make it 13. 13 of 1,000. 2014 is 10,010, and expected for 2015 is 10,020. And let's say the industry growth rate, we did the analysis and found that that particular industry that the company ABC is in is growing at 5%, so that will be a G. And let's say we did the calculation for this particular company and the industry, and we came up with the discount rate is 25%. So now if we do the calculation using the terminal value formula, we will get that this company enterprise value is 5355. Again, all I'm doing is using the R of 25%, G of 5, and the CT, or the cash in this case, is 1020, which I'm using the current estimate for the cash flow for current year. Now, and because we're using today's cash flow, which is 2015, we don't have to discount it. So in that case, the value of enterprise will be 5335. Okay. Next, I want to touch on other methodologies, and again, this is in chapter 6, so you should read it. And what do I mean by that? So let's say, for example, if I go in and show you where, I think most of you, based on some of the questions I've received, know where it is, but just to kind of point out to some of you who may have not gone that far, this is the chapter 6. So here is the price multiples. In here, I think you should read it, understand it. This knowledge, and again, obviously, you'll have this book. This knowledge and this material in these 3 chapters will be very, very helpful, along with the recordings for MBA 640, 680, and 690. And here it talks about different, ratios. What are the nuances for each one of them? Price to earning ratio, for example. Price to book talks about price to sales ratio, and so on. And what I will suggest you do is, obviously, then there's a conversation choosing the right multiple. And you're going to start to see that it is not a perfect science. And again, this is where, experience, knowledge, depending upon the industry, so it depends on which industry you're in and so on. So let me talk about a couple of them so you know the methodology, how you would do it. So I'm getting back to my Word document. So let's say, when would we use this thing? This is where we do not have the specific detailed cash flow for a business like we do with Max Inc. The best methodology to do valuation is to use the DCF method. Now that presumes we have the data to be able to do that. And obviously, if we start a business, we can do that. So obviously, if a case study has that level of information, then the DCF is the best way to do it. But sometimes you're going to find in a case study that they might just talk about multiples. Okay, so they will give you some information, and then you'll have to do some calculation. So here I'm going to kind of walk you through some of the thought process. So here, if there is detailed cash flow available like Max Inc., obviously DCF is the way to go. But if not, then there are other more simple methods available to estimate the valuation. Okay, and again, chapter 6, as I pointed out to you, showing you that the copy of the chapter 6 from the book. Very, very information will be useful for you in case studies in MBA 640 and 690, and also for developing a business plan in 680. So here is a brief discussion of how to use multiple. Here I will cover 2 of them just to kind of give you a feel for it. I will do the price to earnings, and I will do the EBITDA ratio. So price to earning. Now, in order to do price to earnings, we need 2 things, obviously. One is the earnings, and the second one is price to earning multiple. So we'll talk about both of them. Earnings is the net income, which means whatever your target company is, or whatever your company you're investigating, let's say Max Inc., you will be using that income, and that will be the earning part of the calculation. Okay, price to earning multiples is based on research. Okay, there are a couple of venues to do it. One would be is to see if you can find companies that have been recently sold. Similar type companies, obviously in same industry. If it is a technology, it should be in technology. If it's computer, it should be in computer. If it's auto company, it should be in auto company. If it is, furniture, then it should be in furniture business, and so on. And companies that recently sold, and if by chance, if the research allows you to find out at what price were those companies sold at, and for that company, what was the net income? So let's say you find 3 similar companies were sold in the same industry, and company A was sold, enterprise value, it was sold for $2 million, and the average net income over the last few years for that company was $250,000 or $250,000. So the price to earning multiple for this company will be 8, which is the price, which is $2 million, divided by $250,000, which is the net income. So that's price, and again, net income is same thing as earnings. Let's say another company you find that was bigger company, sold at $5 million, and its net income was $600,000, and so price to earning ratio is 8.33. Again, 5 divided by 600, $5 million divided by 0.6 million. Let's say company C was sold, smaller company was sold for $1 million, and the average net income for that was 100. So in that case, the price to earning multiple is 10. So now we have 3 companies. We can average those 3 numbers, and we get 8.78. So once we have that, so what do we do with it? We take that 8.78, which is the price to earning multiple, and we apply to the earnings, which is basically a net income of the company. So let's say, for example, we are looking at a company X that we want to see if we can price it or value it using price to earning ratio. We found out in the industry where those three companies were sold, we came up with a multiple of 8.78. Let's say this company X has a net income of 230. Using this multiple, multiply 230 by 8.77, this methodology will say this company is worth about $2 million, okay, $2.018 million, okay. Now, what if the company under investigation is not in a stable zone? It is like in a high growth rate like Max Inc. So what do we do in that case? Like suppose you're looking at it and obviously which net income do I use? Obviously do I use for year 2014, 15, 16, 17? In that case, we would basically do is to look at the net income over a longer period, like all 10 years, and take an average. Basically, which means you add up all the net income for 10 years and divide it by 10. And then we multiply it by the multiple, and again, assuming all those three companies are in the same industry as Max Inc. and so on. So in a nutshell, if we can find data for similar companies that were sold, and we get the price to earnings multiple, and we average it if there are 3 or 4 companies, and then multiply it to the net income of the company we're investigating. Now, shifting gears a little bit. What if we cannot find the information on any specific company sold in the and its corresponding net income, or the case study has not provided information? Sometimes case studies will, but if they don't. If that is the case, then one can use price to earnings for publicly traded companies, but again, they have to be in the same industry that the data is available on. And you can find this on Yahoo Finance, okay, or Google Finance, but I will use Yahoo Finance as an example. So step 1 will be identify companies in similar industry. Let's say you're looking at furniture companies, you're going to find Ethan Allen and other companies like that. You're going to go to Yahoo Finance and get the PE ratio, and I'll show you what it will look like in a second. And then you look at few other companies, 3 or 4 furniture companies, and you look PE for each one of them, and you average it. So you identify 4 or 5 companies, or at least 2 or 3 companies, and you average it. And once you have the ratio, you can apply that ratio to the target or the company we're investigating's earnings. Okay. Now here is a screenshot of Yahoo Finance. I just basically looked at Ethan Allen as an example. I went to, on the left side are all the tabs. I went to key statistics, and on key statistics is telling me what is the market cap, which is, if the company, if you look at the value of the company in terms of stock price, it is $766 million. Okay, now here are the ratios. So for example, on third from the bottom, it says trailing PE. One below that says forward PE, but PE is price to earning. If both trailing and forward are available for your analysis, I would use the forward, which is a better number in terms of more useful information than trailing. Trailing basically is based on historical data. Forward is basically what is they're expecting the earnings to be in the future. So I would use price to earning multiple in this case would be 14.9. Also, remember I told you there are other multiples in the book, and here is other. If you want to find it, price to sales, for example, price to book, enterprise value, or the price to EBITDA, which is the other one I want to talk about it. So here is where you can get the data. So above is screenshot from Yahoo Finance for Ethan Allen. Under key statistics, if both trailing and forward are available, I would use the forward. In this case, it's 14.09. And again, you will multiply that by earnings. Now let's look at another ratio, okay, which is want to use EBITDA as a multiple. So EBITDA for this company here was 8.73, and again I would look at more than one company. I would look at Ethan Allen, maybe other couple of furniture companies, and take an average, and then I would multiply that by EBITDA. Now the next question is, what is the EBITDA? EBITDA basically is earnings before interest and taxes, and depreciation and amortization. We know by now what EBIT is. It's on the income statement, right above the interest, because it is earnings before interest and taxes. So it is an income statement. Depreciation is also on the income statement, and so is the amortization, okay, and it will also come from the income statement. Now, what is amortization? Amortization is like depreciation. Depreciation is for, as we are expensing some fixed assets. Those are tangible assets, which means you can physically touch them. Amortization is also a non-cash expense like depreciation, but it is a amortization of intangible assets like a goodwill. Okay, sometimes when company have goodwill on their balance sheet, they amortize it, and so it is called amortization. So the EBITDA will basically be if we do not have, for example, for MaxInc, we do not have any amortization. So in that case, EBITDA will be basically depreciation, EBIT plus depreciation. But for future case study, in different courses, if there is amortization, you'll basically also add back to use this methodology. So also note that in the case of Max, because there is a growth phase in the first few years, which EBITDA will be used? We got EBITDA for every year. Well, we would do the same thing like we did with price to earning ratios. We'll take the EBITDA for 10 years, add them up and divide it by 10 and use the average EBITDA for the 10 years. And then we take that and multiply that by 8.73, assuming that that's the multiple for the average of the EBITDA of the companies in the same industry. Just a note, obviously, I just use one company in this example. You should look at 2 or 3 and take an average of it. Now, you should definitely get familiar with all the ratios. So this way you can have a conversation if you have to for a case study or in the MBA 640 class. So please read chapter 6 and also do some on your own research. But if I had to pick one, of all the multiple, aside from the DCF, which is the way to do it if you have the cash flow available, but for the price multiple, the examples in chapter 6, I recommend using EBITDA multiple. Why? Because it is an estimate of the operating cash flow of the business. And cash flow is a better measure of value of the company than net income. Again, if the enough data is available, we always want to use the DCF methods like I talked about in the front. But anyway, so please listen to this lecture, take notes, read those chapter 5, 6, and 7, and I think it will be very, very helpful for you, not only for this class, but also for the MBA 640 especially.